market may be, trading a bit lackluster on the sideways, the broader markets are witnessing very good moves even today. So let's take the discussion on markets forward with Anthony Heredia, who's joining us. He's the MD and CEO of Mahindra Manulife. Anthony, afternoon. Thank you so much for your time. Let me start our discussion with the broad view on the market, because market seem to be getting pretty divided on where the valuations are right now. What phase of the market cycle are we right now? Some are saying mildly profit, others are saying long way to go. Where do you stand on valuations?
So I think our view would be it's a long way to go if you have a long time frame in mind, right? I think if you have a shorter time frame, then certainly I think valuations will worry you. But even there, I think, it's not a one-dimensional call. Markets on an overall basis obviously are a lot more expensive than they were, let's say, 3 or 6 months ago. But there are lots of pockets in the market that we still think there is value in. But from a longer term perspective, I think there's a larger degree of comfort. So for investors like us who tend to think in terms of 3 and 5 years when we look at buying a stock, we find enough opportunities where valuation is not really a concern.
Anthony, what about the cycle of the economy or the business cycle? How do you see the business cycles right now in India? Because I understand you're also in the middle of launching a business cycle fund. How all of that panning out, looking at the quality of earnings?
So the one context was, from our personal perspective, to probably create a thematic fund that has a long life. And we thought something that has the ability to adjust to various themes based on which business cycle and market cycles are aligned made a lot of sense. Coming to the market, I think one truth that seems to be emerging is that nothing is permanent in terms of the way markets take fancy to particular sectors and themes. At the same time, in our own experience of managing money, particularly in the last 1 year, I would divide it into two parts. I mean, there are certain market fancies that perhaps you are best ignoring and sticking to what you believe will pay out in the long term. And then because we're living in a very dynamic world, there's a second set of themes. Let me give you an example. I think the emergence of how artificial intelligence can perhaps transform many businesses, including those in tech, those are themes that you kind of want to take a context of and probably adjust portfolios. So I would believe that, you live in a dynamic world is probably a more general truism. But when I think about markets over the next 3 or 5 years, I would break it, like I said, into two parts. There are certain businesses we will own that we would believe will survive multiple changes in business cycles and themes. And there will be other businesses that you will need to adjust your portfolios based on how macros kind of move, which in the past may not have moved very dramatically. But I think we should be aware that technology, adoption of digital, etc., will disrupt quicker than we expect in certain businesses, and we need to adjust.
Right. Anthony, also, you had launched a small and mid-cap fund as well. We are seeing there's huge interest from the market towards mid-cap and small caps. How have your funds been, and what are your call right now on that pocket of the market in terms of valuations?
Ajay, at the risk of my sales team crucifying me for my answer, so we launched our small cap fund in December, right? Which in hindsight looks like outstanding timing. I must confess that we had no timing in view. We just thought we needed to create a product in that space, and that's obviously done extremely well. At the same time, do I think the broader market has legs? The answer to that is also yes. Are, however, investors getting too caught up in, let's say, market caps that are doing really well at this point in time or sectors? I think the answer to that is also yes. So our advice to investors has been, if you don't have small caps in your portfolio, you should certainly add them. But if you already have small cap funds, then perhaps the wiser thing to do over the next 3 or 5 years is add diversified multi-cap and flexi-cap funds.
Have you been watching, the way SIP data is coming back, very strong flows. How are flows to your own funds? And especially if you could also talk to me a little bit about how flows are coming from non-metros, the tier 2, tier 3 kind of regions across the country?
So Ajay, my view is actually SIPs are quickly now becoming a consumer product. They're no longer a financial product, right? I mean, I sometimes meet investors who tell me that I have bought an SIP, but I don't own mutual funds, right? I mean, that's the extent of difference, the way people view it. Uh, Flows from both tier 2 as well as tier 1 cities, I would say, are equal. I don't see trends which suggest that investors in smaller markets like SIPs more than investors in larger markets. I think the perspective I have is investors who are new to the industry seem to be coming in through the SIP route, which I think is good because that's probably the best way for them to invest. I genuinely think that the SIP book over the next 5 or 10 years will be an even larger growth story for the industry than just overall assets. That's my personal view, because I just think it's an outstanding way for any retail investor to buy a fund or be invested in equity.
Anthony, how are you looking at the near term in terms of the kind of earnings quality we have actually India Inc. is actually posting right now?
So we're quite comfortable with earnings quality. There is a theme that we expect to start playing out, which is you're at perhaps the peak of the rate cycle. And so to some degree, some of the earnings, I would believe, will move from the lenders to the borrowers. So while I think that within particular sectors, earning will change. For example, I think for banks to kind of look at keeping NIMs at the levels they are, maybe a little challenge looking forward a year or two. On the other hand, for sectors like industrial, cap goods, consumer, etc., we would believe earnings quality to continue to remain robust and perhaps even improve. So at a broad market level, I don't think we see too much of a concern on earnings. Is it reflective of the current market sentiment and momentum? Perhaps the market is a little bit ahead of what earnings are. But like I said, this is a market where clearly you need to think longer term in terms of how you are seeing the earnings trajectory and the opportunity. In the short term,